You might be thinking, Florida real estate is finally bouncing back. On the surface, it looks like it. Palm trees are still swaying. Just sold signs are back in front yards, and realtors are talking about a soft landing. But behind that picture, something much darker is happening. An insurance crisis is quietly crushing families who thought they were safe. Teachers and nurses with a combined income of $140,000 are discovering that even they can't keep up when home insurance runs $8,000, $10,000, even $12,000 a year, before you even add property taxes and flood coverage. Last year, we talked about Florida's housing reset. In 2026, the story has changed. New data shows that in some cities, you now need well over $180,000 a year just to comfortably carry an average home plus insurance. At the same time, insurers are pulling out, forcing people onto last resort state plans or leaving them with no affordable coverage at all. This isn't just a housing problem anymore. It's housing, insurance, climate risk, and investor flight all colliding at the same time. And some Florida cities are starting to look more dangerous than 2008 ever did. In this video, we're breaking down 10 Florida cities where affordable Florida living has quietly turned into a financial trap. Let's begin with number 10, Cape Coral. Cape Coral stretches across 120 square miles of southwest Florida canals, where for sale signs now outnumber boats docked in backyard waterways. What was supposed to be affordable waterfront living has transformed into an insurance death trap for many families. Here's the brutal math behind those canal views. Median home prices have fallen about 8% from recent peaks to around $415,000. But that's not the whole story. Properties sit an average 89 days on market, up more than 125% from last year, while homeowners discover insurance premiums have quadrupled or even quintupled since 2019. In some neighborhoods, families are paying close to $8,500 annually for basic coverage, with flood insurance adding another $3,000 minimum. For a middle-class family earning $110,000, Cape Coral's reality often means spending 45% of gross income on housing alone, before utilities, food, or healthcare. Local teachers making $52,000 annually discover their take-home pay can't even cover the insurance bill. Nurses earning $68,000 watch as waterfront condos, once symbols of coastal success, become financial anchors, dragging families underwater. The crisis accelerates when you see inventory surge more than 150% year over year, while buyer traffic evaporates. Investment firms that bought thousands of homes during the pandemic are now dumping properties at losses, flooding an already oversaturated market. And if Cape Coral's waterfront collapse feels devastating, just wait until we examine what's happening in a tourist town where vacation rentals became financial tombstones. Number 9, Kissimmee. 20 miles south of Orlando's theme park empire, Kissimmee's tourist corridor tells a story of vacation rental carnage where pink flamingo decorations frame foreclosure notices. The historical context reveals devastating shifts. Short-term rental investments that promised 12% annual returns are now hemorrhaging cash as occupancy rates have plummeted more than 30% year over year in many properties. Median home prices dropped roughly 7% to around $385,000, while days on market extended to 76, nearly double last year's pace. Here's what families face. Property taxes jumped around 18% as home values declined, creating an impossible squeeze where declining equity meets rising costs. Insurance premiums hit $6,000 plus annually for standard homes, with tourist-heavy neighborhoods facing policy cancellations as carriers flee concentrated risk zones. Investors who leveraged Disney's proximity are discovering their Airbnb empires crumbling. Properties purchased for $420,000 in 2022 now list for $369,000, negative equity erasing down payments and crushing retirement dreams. The vacation rental ordinance crackdown eliminates traditional exit strategies as Orange County restricts short-term permits. Local families earning Orlando's median income of $67,000 find themselves priced out entirely as investor panic creates downward pricing spirals. Nurses at nearby hospitals spend over half their income on housing while competing with desperate sellers offering seller financing and assumable mortgages at above-market rates. The situation intensifies when you realize this isn't just tourist market volatility. For many property owners, it's systematic collapse of an investment bubble built on unsustainable leverage. Number 8. Daytona Beach. Daytona Beach sits on Florida's Atlantic coast, where racing culture, beachfront motels, and blue-collar families once defined one of the state's most affordable coastal markets. Today, those same ocean views frame an insurance crisis that is turning working-class dreams into financial emergencies. Market data shows Daytona Beach entering a dangerous new phase. Median home prices have slipped around 7% to roughly $361,000, but affordability hasn't improved. Insurance premiums now average $9,600 annually for standard homes, and anything within the coastal wind zone frequently jumps to $14,000 or more. Costs that dwarf the price declines. Properties sit an average 92 days on market, more than double last year, as buyers hesitate to take on extreme insurance bills. For Volusia County's working families, warehouse workers earning $42,000, hotel employees at $33,000, medical assistants earning $41,000, the math simply doesn't work. Many discover that insurance premiums alone now exceed what their mortgages used to be. Even dual-income households earning $85,000 struggle to qualify for homes that once felt achievable. The Airbnb collapse magnifies the crisis. Beachside condos purchased as short-term rentals in 2021 now sit vacant as occupancy rates plunge and insurance policies are canceled or non-renewed. Investor sell-offs are accelerating, flooding the market with distressed properties at the same time everyday families can no longer afford coastal risk coverage. And if Daytona Beach's working-class collapse feels alarming, wait until we move to a Gulf Coast city where luxury waterfront living is unraveling even faster, and where wealthy retirees are discovering they're not protected from Florida's insurance disaster. Number 7. Sarasota. Sarasota stretches across Florida's Gulf Coast, where arts districts, pristine beaches, and luxury neighborhoods created one of the state's most desirable retirement markets. But that prestige has become a trap as insurance costs explode faster than high-income buyers can adapt. Recent data reveals Sarasota's downturn accelerating beneath the surface. Median home prices have fallen around 6.5% to approximately $499,000, but insurance premiums have surged so aggressively that price declines offer no relief. Standard homes often face yearly premiums between $11,000 and $16,000, while waterfront properties see quotes topping $28,000 or more. Several carriers have fully exited Sarasota County, leaving homeowners dependent on Citizens or specialty insurers with restrictive coverage. Wealthy retirees who once flocked to Sarasota's barrier islands now face a hard awakening. Couples living on $120,000 to $160,000 retirement incomes discover that their insurance plus HOA plus flood coverage can exceed $3,000 a month before paying a single dollar toward the mortgage. Many now attempt to downsize, but rising insurance forces them into negative equity scenarios that eliminate their options. The collapse is most severe on Siesta Key, Longboat Key, and the waterfront edges of Palmer Ranch. Investors who bought condominiums for rental income now confront rising HOA special assessments tied to new safety and wind mitigation requirements. Some buildings require $50,000 to $80,000 per unit assessments, numbers that push owners into forced sales. Demand destruction is spreading as affluent buyers shift to states like North Carolina, Alabama, and Tennessee, where coastal insurance is a fraction of Sarasota's cost. Homes linger 100-plus days on market, signaling the luxury slowdown has begun. Sarasota's crisis shows a painful truth. When even wealthy homeowners buckle under insurance pressure, the rest of Florida is in far deeper trouble than anyone realizes. Number 6. Ocala. Ocala's rolling horse country stretches across Marion County, where thoroughbred farms once represented rural Florida prosperity. Behind white wooden fences and Spanish moss, an insurance crisis is transforming equestrian estates into financial prisons for families. Multi-source verification confirms catastrophic shifts. Median home prices have fallen roughly 11% to around $312,000, among the steepest year-over-year declines in north-central Florida. Days on market hit 103 as inventory surges nearly 190%, with luxury equestrian properties showing the most dramatic distress. Properties over $800,000 sit an average 167 days, with price reductions averaging 14% before eventual sales. Here's the brutal math behind those pastoral scenes. Insurance premiums have jumped over 300% since 2020, with carriers citing wildfire risk and aging housing stock built during 1970s to 1980s construction booms. Families pay close to $8,900 annually for standard homes, with ranch properties requiring specialty coverage hitting $15,000 to $22,000 yearly. The economic fundamentals reveal systematic collapse. Marion County's median household income of $52,000 can't support housing costs that demand $85,000 plus to qualify under traditional lending standards. Teachers at Ocala's public schools earn $46,000 while competing for homes against fleeing retirees dumping properties at any price. Local equestrian industry workers, trainers earning $38,000, stable managers at $44,000, veterinary technicians at $41,000, face complete displacement as affordable housing inventory evaporates. Properties that housed multi-generational farm families now sit vacant as insurance costs exceed mortgage payments for homes purchased decades ago. The crisis multiplies through commercial agriculture impacts. Horse farms that employed 30 to 50 workers reduce staff as operating costs surge, eliminating the employment base that supported Ocala's housing market. Veterinary practices serving thoroughbred operations cut hours as farms relocate to Kentucky and Virginia, where insurance costs remain more rational. Market dynamics show price discovery failing completely in some neighborhoods. Sellers list at $350,000, reduced to $315,000, then $289,000, finding no buyers because insurance quotes arrive at $900 plus monthly, eliminating qualification for mortgages that seemed achievable based on purchase price alone. Number 5. Lakeland. Lakeland sits between Tampa and Orlando, where phosphate mining history built blue-collar prosperity. Now those mid-century block homes with citrus trees and backyards face an insurance crisis that's gutting Middle America's last affordable Florida outpost. Historical pattern validation reveals Lakeland following a similar trajectory that destroyed inland California cities during 2008 to 2010. Median prices have dropped roughly 11% to around $328,000, while inventory has surged nearly 200%, among the highest rates in the Interstate 4 corridor. Days on market hit 97, with starter homes under $300,000 showing the fastest deterioration as first-time buyers evaporate from the market entirely. Here's what working families discover. Insurance premiums jumped from around $1,800 in 2019 to over $8,400 in 2024, an increase that destroyed housing affordability faster than any price decline could restore it. Families earning Lakeland's median income of $58,000 watch as properties they could afford on paper become impossible when insurance adds $700 plus to monthly housing costs. The impact cascades through essential worker communities. Polk County teachers making $49,000 find themselves priced out of districts they serve. Nurses at Lakeland Regional earning $69,000 discover that even dual-income households earning $125,000 struggle to qualify when insurance costs push debt-to-income ratios beyond lending limits. Amazon's massive distribution center, Lakeland's economic cornerstone employing 3,500 hired workers, faces retention crises as warehouse associates earning $35,000 to $42,000 can't find housing within 30 miles. The company's expansion plans stall as workforce housing becomes unsolvable. Construction permits crashed over 70% year over year as builders abandon markets where insurance costs make new construction financially impossible. Homes sit half-framed as contractors file bankruptcy, leaving buyers trapped in purchase agreements for properties that may never close. Regional experts warn Lakeland could represent Florida's canary in the coal mine when the state's most affordable inland city becomes unaffordable through insurance costs alone. The entire market structure may be at risk. Number 4. Tampa. Tampa Bay's downtown skyline rises above waterfront condos where Hurricane Ian survivor bumper stickers frame an insurance crisis that's destroying one of America's hottest pre-pandemic markets. Comparative market analysis reveals Tampa's unique vulnerability. While Miami shows around 5% price declines, Tampa has fallen nearly 13% to a median around $425,000 as insurance costs and hurricane exposure create perfect storm conditions. Days on market hit 86, up over 130% year over year, while inventory explodes more than 200% as sellers panic before 2025 hurricane season. Here's the devastating reality behind that waterfront skyline. Insurance premiums average close to $11,200 annually for standard homes, with waterfront properties hitting $18,000 to $28,000 when flood coverage combines with windstorm policies. Families discover that Tampa's desirability means nothing when insurance costs exceed mortgage payments on homes purchased during 2020 to 2021 peak. The human cost multiplies across income levels. Hillsborough County teachers earning $51,000 find themselves competing for affordable housing in Brandon and Plant City, 30-minute commutes that add around $400 monthly in gas costs. Nurses at Tampa General making $74,000 watch as starter condos they could afford require $1,100 plus monthly insurance premiums that destroy qualification ratios. Tampa's tech sector, the economic engine supposed to stabilize the market, faces some exodus as remote workers relocate to Austin, Denver, and Raleigh, where housing costs make more sense. Software engineers earning $125,000 discover that Tampa's affordable alternative to California narrative has weakened significantly when insurance costs eliminate much of the value proposition. Downtown condo market shows some of the most dramatic carnage. New construction towers completed during 2022 to 2023 sit around 40% vacant as investors who bought pre-construction discover rental income can't cover $8,000 plus monthly carrying costs when insurance, HOA fees, and property taxes combine. Developers offer free Tesla vehicles and 2 years of HOA fees waived. Desperation strategies revealing demand destruction. The waterfront luxury market faces systemic collapse in some areas. Properties over $1.5 million show 287 days on market with average price reductions around 22%. Sellers who relocated from the Northeast discover their Tampa dream homes became financial nightmares as insurance companies flee coastal exposure entirely, leaving only Citizens property insurance at 3 to 4 times market rates. Investment firms that bought thousands of Tampa homes during pandemic are now dumping inventory at losses averaging around 18% from peak purchase prices, flooding an already oversaturated market with distressed properties that compete with traditional homeowners trying to escape. Number 3. Fort Myers. Fort Myers stretches along the Caloosahatchee River, where Hurricane Ian's 2022 devastation still scars landscapes and housing markets. Behind rebuilt palm trees and fresh construction, an insurance crisis ensures Ian's economic destruction continues. Trend analysis reveals severe acceleration. Median prices have dropped about 14% from recent peaks to around $389,000, while active listings surged more than 220%. Among the highest inventory explosions in Southwest Florida. Days on market hit 112, with properties in Ian-damaged neighborhoods showing 156-day averages as buyers flee hurricane risk entirely. Here's the brutal math families face. Insurance premiums jumped from around $3,200 pre-Ian to close to $14,800 post-Ian for similar coverage on the same properties. Families who rebuilt discover their insurance costs more than doubled while coverage limits dropped around 40%. Flood insurance that was optional in 2021 is now mandatory, adding $4,200 to $8,500 annually for homes in newly designated FEMA flood zones. The economic reality shows Fort Myers becoming extremely difficult to insure affordably for middle-class families. 15 major insurance carriers exited Southwest Florida entirely after Ian, leaving homeowners dependent on citizen property insurance. The state's insurer of last resort charging rates 300 to 400% above pre-Ian market levels. Properties that could sell for $450,000 in 2021 now list around $379,000 and sit for months because insurance quotes arrive at $1,200 plus monthly, eliminating buyer qualification. Lee County's essential workers face significant housing challenges. Teachers earning $50,000 discover affordable housing has largely disappeared as investors fled and insurance costs destroyed entry-level market affordability. Nurses at Lee Memorial making $71,000 compete for rentals 40 miles inland, where insurance costs remain merely high rather than extreme. Construction workers rebuilding Fort Myers can't afford homes in cities they're reconstructing. The situation sees electricians earning $58,000, plumbers at $62,000, and HVAC technicians at $54,000 commuting from Port Charlotte and Punta Gorda, burning $500 plus monthly in gas to rebuild communities they'll likely never afford to live in. Regional market dynamics reveal Fort Myers may be showing other coastal Florida cities their future as climate risk and insurance costs make waterfront living economically challenging for middle-class families. The investor exodus shows smart money recognizing reality before traditional buyers. Thousands of investor-owned properties hit the market in late 2024, representing significant liquidation before 2025 hurricane season potentially delivers another major storm. Number 2, Jacksonville. Jacksonville sprawls across northeast Florida, where military families and logistics workers built equity in the state's most affordable major metro. Behind those massive warehouses and naval installations, an insurance crisis is destroying what was Florida's last affordable market, where middle-class families could still succeed. Multi-source verification confirms systematic devastation. Median prices have fallen roughly 14% to around $342,000, while inventory surged over 230%. Among the most dramatic market reversals in Florida's major metros. Days on market hit 94, with suburban communities showing the fastest deterioration as families flee insurance costs that arrived seemingly overnight. Here's what Jacksonville families discover. Insurance premiums jumped from around $1,650 in 2020 to over $9,200 in 2024, an increase destroying affordability faster than any wage growth could compensate. Properties families could afford at $1,800 monthly suddenly require $2,600 plus when insurance costs quadruple, eliminating qualification for mortgages that seemed achievable months earlier. The military family crisis reveals brutal realities. Naval Station Jacksonville personnel earning $45,000 to $75,000 discover BAH housing allowances, designed to cover local housing costs, now fall $600 to $900 short monthly when insurance costs combine with surging property taxes. Families face impossible choices: accept negative cash flow or relocate to Georgia and Alabama, where commutes exceed 90 minutes. Logistics sector workers, Jacksonville's economic engine employing 47,000 people, face housing displacement. Warehouse managers earning $68,000, truck drivers at $52,000, and forklift operators at $38,000 watch as starter homes disappear while insurance costs make even affordable properties financially challenging. Duval County teachers making $48,000 face the cruelest irony. Home prices dropped dramatically, but insurance costs have eliminated much of the improved affordability. A $280,000 home looks achievable until insurance quotes arrive at $850 plus monthly, pushing total housing costs beyond qualification limits for many buyers. The new construction crisis multiplies the disaster. Builders who started projects during 2022 to 2023 discover they can't sell completed homes because buyers can't secure affordable insurance. Entire subdivisions sit around 70% unsold as builders slash prices 15 to 20% below construction costs, taking massive losses while banks threaten construction loan defaults. Amazon's logistics expansion, supposed to stabilize Jacksonville's market, now threatens contraction as the company struggles to recruit workers who can't find affordable housing. The economic engine that drove Jacksonville's growth now sputters as workforce housing becomes increasingly difficult to solve. Number 1. Panama City. Panama City stretches along the Emerald Coast where Hurricane Michael's 2018 Category 5 devastation should have been the warning. Instead, investors and families rushed in during the pandemic, buying into a market where insurance companies already planned their exit. Now those white sand beaches frame what could be one of Florida housing's darkest futures. Resident experience verification confirms severe collapse. Median prices have fallen about 17% from recent peaks to around $358,000, among Florida's steepest major market declines. Days on market hit 127, with beachfront properties averaging 198 days as buyers refuse to touch coastal exposure at any price. Active listings surged more than 265% year over year, while pending sales dropped over 50%, revealing demand destruction accelerating faster than prices can adjust. Here's the ultimate brutal math. Insurance premiums average close to $16,500 annually for standard homes, with beachfront properties requiring $28,000 to $45,000 when flood and windstorm coverage combine. Families discover that even at dramatically reduced prices, they can't afford Panama City because insurance costs exceed mortgage payments on homes purchased at current values. The human devastation could reveal Florida's future. Bay County teachers earning $47,000 face near-complete displacement as affordable housing has largely ceased to exist. Not from high prices, but from insurance costs that make even $250,000 homes challenging to afford. Nurses at Bay Medical making $69,000 watch as entry-level homes require $2,800 plus monthly housing costs when insurance combines with taxes and HOA fees. Tourism sector workers, Panama City's economic foundation, face housing extinction. Hotel managers earning $52,000, restaurant supervisors at $38,000, retail workers at $32,000 discover they're serving a vacation paradise they can't afford to live in. The situation sees families commuting 60-plus miles from Alabama and inland Georgia to work jobs in a city where middle-class housing has become extremely difficult. Construction workers who rebuilt Panama City after Michael can't afford homes in the city they reconstructed. Electricians earning $61,000, plumbers at $65,000, carpenters at $54,000 face brutal reality. They literally built houses they'll likely never afford to buy because insurance costs make middle-class homeownership mathematically challenging. The investor exodus shows smart money recognizing Panama City's severe challenges. Short-term rental portfolios purchased for millions during 2020 to 2022 now list at significant discounts. Investors accepting major losses to exit before catastrophic hurricane losses or further insurance market deterioration eliminates buyers entirely. Regional economic data confirms troubling patterns. Bay County's population growth reversed for the first time since Hurricane Michael as families flee insurance costs faster than job market growth can offset. The scenario sees Panama City potentially becoming a cautionary tale. Beautiful beaches, recovering economy, and very few middle-class families who can afford to live there. In some ways, insurance companies fled Panama City first. Much of the rest of Florida may be following a similar path, just 2 to 5 years behind. Final take. Florida's housing crisis isn't on the way. It's already here, and these 10 cities show how fast it's spreading from the coasts to the inland safe markets. We've seen Cape Coral's waterfront dream turn into an insurance trap for many families, Kissimmee's vacation rental boom flip into a bust, and Palm Bay's Space Coast workers watch their equity melt away. Port St. Lucie's retirees are discovering that fixed incomes can't absorb 600 or 700 monthly insurance bills, while Ocala's horse country estates are becoming financial prisons for families who thought they were set for life. Lakeland, once one of Florida's last affordable inland cities, now proves that insurance alone can destroy affordability. Tampa's shiny condo towers hide vacancy and investor losses. Fort Myers is still living with Ian's economic aftershock. Jacksonville's military and logistics families are learning that affordable big city no longer means affordable home ownership for many. And Panama City shows us what could be the final stage, a market where even falling prices can't save middle-class families because insurance costs are higher than the mortgage. When that happens, the entire Florida housing model faces serious challenges. As we move through 2025 and into 2026, more insurers will likely raise rates, pull back coverage, or leave the state entirely. These 10 cities are just the ones feeling it first. The math is brutal. Shrinking equity, rising insurance, and fewer qualified buyers create a feedback loop where selling becomes harder and staying becomes a financial risk for many homeowners. We may be watching just the opening chapter. Florida's insurance crisis is turning what used to be a sunshine dream into a middle-class nightmare for many families, and the rest of the country is watching. Hit that subscribe button because next week, we're exposing the Southwest cities where water rights battles are quietly destroying property values faster than foreclosures did in 2008. You don't want to miss that one.